Many covered call ETFs I see pay out everything they earn and more. GPIX only pays out 39%. That 8% yield you're seeing could potentially be higher. In this video, we're breaking down GPIX, where it differs from other covered call funds, what the numbers show, and what it means for investors. Also, a big thank you to our subscriber, Crutmaster V4791, for requesting this video. If you have a fund or financial product you'd like me to review, leave it in the comments. I've reviewed other covered call funds like SPYI and QQQI on this channel. Check those out too. First, even though GPIX is called the S&P 500 Premium Income ETF, it may not purely replicate the S&P 500 index. According to the GPIX prospectus, at least 80% of the net assets must be invested in the benchmark, which is the S&P 500. However, the fund also notes that the funds may, from time to time, temporarily use a different investment strategy. When a fund does so, the fund may not be achieving its investment objective. When I examined the downloadable holdings data, I found VOX, the Vanguard Communication Services ETF, listed as a holding with about a 4% weight. When investors check the website, this holding may get disaggregated into individual stocks in the overall portfolio view, which may explain some discrepancies between the website's top 10 holdings display and the downloadable data table. The point is this: GPIX's manager has some discretion around investments. Investors should monitor the fund's holdings at reasonable intervals rather than assuming it always mirrors the S&P 500 exactly. Second, the fund is relatively new, having only launched in October 2023. It has about $3 billion in net assets and has a current expense ratio of 0.29%. Regarding the expense ratio, it appears a portion has been waived by Goldman Sachs until April 2026. It's unclear whether or not the expense ratio waiver will remain in effect after April. In the event it is not maintained after April, the expense ratio might increase to 0.35%. The opportunity with GPIX looks to be its distribution potential. At the moment, GPIX is distributing about 39% of its income. Now, to be clear, that's 39% of all its income. Realized and unrealized investment gains and losses, investment income, option premiums, losses, and fund expenses. If you look at other funds like SPYI and QQQI, the distribution yields are higher at 12% and 14% respectively, but the current payout ratio might also be higher. Based on the June 2025 financial statements, the option strategy appears unprofitable. For the 6 month ended June 2026, GPIX lost about $9 million writing options. So why do I think this is an opportunity? Two components. First, the distribution ratio is well below 100%. GPIX is letting some income accrue to NAV. For income-focused investors, the opportunity is that GPIX adjusts its distribution strategy higher to be closer in line with other funds in the category. Investors could receive additional current income by the expense of NAV growth and higher risk to distribution sustainability. The second component is the options trading strategy, which is currently a drag. If GPIX can make their strategy profitable, then that has potential to add additional source of earnings, as it is currently not contributing. The bottom line is that GPIX shows characteristics of a more conservative approach among covered call funds. Somewhat of an oxymoron in my opinion, but hey, there it is. The fund is distributing a minority of its income. Investment income from capital gains is typically more volatile and less subject to manager control than option premiums or dividends and interest. Maintaining a lower distribution ratio reduces the risk of future distribution cuts. It also presents upside potential. There's room to increase distributions if the option strategy improves or if management gains confidence in prospective capital gains. And if distributions are not increased, investors still benefit from the increase in NAV whilst enjoying an 8% yield. All considered, GPIX appears to be positioning itself as one of the more conservative options in the covered call space. I still don't like covered call funds, by the way. Hi, I'm Charles. I don't like most investing or finance content I see online. It tends to try to sell you something. You don't need to buy anything from me. This content is for entertainment purposes only. Seek professional advice for your situation. I want to make financial freedom accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.